All right, I just want to get your thoughts on the market's reactions to the MPC decision. I'm hearing that it really has been a muted response so far.
Oh yeah, muted response on the treasury bills. In fact, what happened there was divergent. On the bond side, markets traded bullishly in reaction. Market closed at 14.23% levels yesterday. So what happened was that 2028, which is a bond that is on offer at today's auction, was actually bought so much that it dropped to 13.9 levels. So the bonds majority are now at 13.9, 13.8 levels. It had touched these levels about 3 weeks ago, but we saw some sell-off, profit-taking, that then drove yields back to 14.3. On the treasury bills end, what has happened is different. Different from what we saw on the bond end. It was a sell-off simply for liquidity, because deals done today will settle on Friday, and on Friday there are two major issues, funding issues. Number one being the settlement of today's bond auction, and retail FX funding. There will be a retail FX funding on Friday. We would usually receive a refund of an amount that had been taken 2 weeks ago, and then fresh funds will be provided for, usually a net debit. So those two fundings coinciding on the same day would require that most banks or houses being involved in these transactions will provide enough funding. So that drove the treasury bills market. Reaction in the treasury bill market may be delayed till next week when federal allocations come in. We hear that meetings have started. The amounts that will be shared will be determined and then announced probably before the weekend. And then going into next week, when the system is more liquid, you will see more position taking and reaction on treasury bills end.
All right. I want you to quickly just speak to your expectations moving forward. Now that we've seen the MPC signal a direction, many are suggesting perhaps not very significant in terms of the cut when you consider that there was no move on the CRR. But overall, what are your thoughts on how interest rates are likely to trade moving forward?
Okay, thanks for saying that. We have not seen any change in their monetary policy stance, given that they've left CRR at 22.5. And then not just the rate at that level, they have simply not changed the mode at which CRR is being effected. The rate drop of 50 basis points on MPR is simply an alignment to market. Market had moved further down from 15%, which was an overdrive, which happened last quarter. The last quarter of 2018, simply because there were FBI sell-offs before elections. As at February 16th, 17th, 18th, when elections were postponed, we saw huge demand, despite the postponement and that uncertainty that created. So it's rumored or estimated that about $3 billion must have come in since then. We've seen less than $1 billion increase in the external reserves. But what I'm trying to say is that demand has driven yields and rates down already, and the MPC is simply just aligning MPR to what is happening in the market. If they continue to inch down on rates, of course, keeping an eye on inflation, which is the next concern after, post-election, we don't see major drop, to single-digit levels or maybe 10 or 11%. We expect them to maintain it at between 13 to 13.5 as we are now currently.
Okay, so what's your expectations in terms of how this decision is likely to impact credit creation in the market? How do you see that evolving from here?
As for credit creation, is not just about reducing rates. The creation of availability of credit in itself, especially to the real sector and the small and medium scale sector, is what most analysts and speakers have called for. This has not happened simply because of the risk of bad debt like we've seen. Major banks, even the biggest of banks, have provided very, very humongous sums. And this phenomenon is still there. It's not taken out yet. So basically, rates have inched down. We do not see an immediate impact on credit creation or drop in cost of credit in the short term.
Let's take this to the forex markets. So typically when we begin to see interest rates decline, there are some concerns that there could be pressure on the currency. Overall, what are your thoughts about the impact of this MPC decision on the exchange rate?
Okay, a major driver of Nigeria's exchange rate policy is what is happening at the crude oil space. Crude oil is above 67 and is I mean, it's expected to range between $58 to $68 margin. The benchmark set by the federal government itself is 60, and we're still above 60. External reserves has inched up from 42 to 43 levels. It looks all good for FX, and we'll call for, we'll call for stability right now on the FX side with the continuous intervention by the central bank and export proceeds delivery by most of those who want to sell FX for Naira business. So basically, on the FX side, short to medium term, no pressure, except if anything happens to crude oil price, and then we see a dip in external reserves.